and F could become an M or a B. It's weird stuff. Some of them are easy, some of them are not. If there's a G, if there's a soft mutation, that G goes away. These are debt obligations, either short-term borrowing or current payments of the loans, not interest payments, current payments of the loans that are due within a year. Accounts payable, again, these are your trade credits that do not carry interest. If they do, they're called notes payable. And other current liabilities. Among other current liabilities, these are, for example, your workers worked, but you haven't paid them yet. Okay. I mean, technically speaking, they delivered you the goods, their work, but you haven't paid them, so that's a liability for you. Or your customers prepaid you, but you haven't delivered the goods yet. And we will also define a number called net working capital, short NWC, which is current assets minus current liabilities. Okay? You can think of that as net cash or almost cash-like stuff a company has uh, within a year. So if I'm a short-term creditor to this firm, I'm interested in that. We'll talk more about that sort of stuff in chapter 3 when we're talking about financial ratios. But this doesn't mean as much as it used to mean in 70s and 80s. These days, you may not have that much current assets, but if you have access to credit, for example, Dell is an example of that. Look at their current assets, 35.9, and their cash and receivable is only 20. Let's look at current liabilities, $48 billion. So they actually have negative net working capital. Does that mean that if I'm a short-term creditor to Dell, I should be worried? No. The reason the answer is no, uh, Dell is an established company. They can go to a bank and say, how about you give me a line of credit of $20 billion? The line of credit is a facility banks provide where you have the ability to borrow up to that amount, but you don't have to. A loan is you actually borrow it. Well, as soon as you borrow it, it becomes a liability. The line of credit is the contingent liability. Contingent liabilities are not listed. They're kind of off balance sheet items. So as long as Dell can actually get that, no problem. Dell is actually famous for getting a lot of funding from their own suppliers. They tell their suppliers, you know, you give me the parts, I'm going to pay you in 90 days. But also think of what Dell does. Dell is kind of a just-in-time delivery computer company. As soon as I place an order, the system immediately sends orders for the individual parts to the suppliers. They're shipped. They put them together within 5 days. It's at my door. As soon as it's shipped, they recognize it as the revenue. And, I pay with credit card. So at the latest, within 7 days, they actually have that in their accounts. But it takes them up to 90 days to pay their own suppliers. So they use their own suppliers to finance their activity. Nice gig if you can get away with it, and Dell can. Why? Because these suppliers know that Dell can pay them, They're willing to pay 90 days. And that's about it. And the rest of we have total equity. And this is typically common stock plus paid in surplus. And there are some other things. Comprehensive income. We're going to talk about examples of those. Uh, Common stock and paid in surplus are kind of two different things. When a company issues a share, let's look at Apple, or in this case, Dell. They have 822 million shares. Uh, I don't think there's detail here, but and these shares have a nominal value. A lot of times they attach it, just 1 cent. It doesn't matter what you attach to it, but that's listed as common stock. But when the firms actually sell that share, they're not getting 1 cent. They're getting something more. The difference between the nominal value of a stock and the value you got for selling it is called paid in surplus. And these two are basically called capital in that sense. We also have something called other comprehensive income or comprehensive income. These are things in the income statement that should be in the income statement, but they're not. Partly because they're not realized losses or gains. Think about, and the greatest example is currency translation gains or losses. Suppose you have a subsidiary in Japan. Since it's a Japanese company, it keeps its book in Japanese yen. But by law, US companies have to consolidate their financial statements. That means uh, the mother company and all subsidiaries, they add up their balance sheets and they report the added up one. Same thing with income statement. In fact, anytime you have any controlling interest, it doesn't have to be 100%. It's subject to consolidation. Unfortunately, you have to do it as if it's 100%. Suppose your assets are 100 billion. You have a subsidiary that has assets 100 billion, but you only own 51% of that. You have to use that in consolidation, but you have to report the total 200 as asset. That's why we have a contra item called minority interest. Anytime you have consolidated a non 100%, especially this is true for total equity. Total equity gross minority interest. It's for Dell, that's 95. Okay. Oh, I forgot to say, we also have something called retained earnings. Let's say your company made $200 million this year. If you haven't distributed that to shareholders, that's added to your equity. Okay, that's retained earnings. But if you paid $50 million in dividends, your retained earnings is only 50 million. Technically, this should be accumulated retained earnings. What's going on here? I should have sold more of that Syngin in the morning. Could have bought it back. It's down to 322 now. A lot of people bought it in the morning. They regret it now, so they're selling it. And just, I'm not going to do any problems on balance sheet directly in the class. I have videos for a lot of little problems. I'm going to post them probably this weekend.